All right, welcome to another episode of Asset Coach and Tax Strategist. My name is Robert Wolf, and I am your host. And so I'm so excited to be able to share this content with you today. We're kind of embarking in this tax preparation season, and we've talked about in the past about tax preparation, tax planning. We've talked about assets, inflation. So remember, this channel is really based on my book, Economic Termites and Farming Assets. And Economic Termites talks about the various financial things that eat away at your wealth, like termites do, right? You don't know you have a termite problem until you see the termites, right? All the damage has already been done. Taxes, inflation, time, laws and regulations, meaning our politicians. That's economic termites. Farming assets is really more focused on assets, how to utilize assets. There's something I like to call the asset buddy system. It's a way that I help you understand how to utilize assets together. A lot of people, a lot of experts, a lot of professionals talk about asset building, and they're very, very focused on a particular asset. So you have financial planners focus on equities, right? And so mutual funds, ETFs, stocks, etc. Okay. And then you have real estate guys who only focus on real estate. And then you have business guys. But at the end of the day, when you back up and you look at this from a tax perspective and a wealth accumulation and look at what the billionaires do, the billionaires concentrate then diversify. Okay. And what I mean by that is that they concentrate on a particular area, typically building their business. They get to a point in their business and they start diversifying. And the reason why is because they realize they have a tax problem and they can't figure out how to reduce their tax liability with the focused asset. So then they have to diversify into other assets. We call this the asset buddy system. Now, one thing that is really unfortunate with a lot of professionals is that they want to say one thing is better than another. And that's not necessarily the case. An asset is an asset. Like Robert Kiyosaki says, an asset is something that appreciates and grows in values and can kick off income. Okay, that's an asset. A liability is something that you owe. Now, the interesting thing is that in wealth building, you can actually use liabilities to help build assets. Okay. Oh, debt's bad. Well, depends. Good debt, bad debt. What do you, and even good debt, uncontrolled, becomes bad debt. So it takes a lot of work to really focus on how to accumulate wealth. But in true ability to accumulate wealth, you also need to reduce tax liability. There's this symbiotic relationship. I like to call them fraternal twins, right? They're different, but they're the same. Okay. And so when we're looking at wealth building, you cannot save money on taxes unless you have something to save on, meaning you have to have some kind of wealth. And you can't really truly build wealth without saving money on taxes, because if you have a 30%, 37% plus drag on your wealth accumulation, it takes more work, more time to be able to build that. Asset buddy system is designed to say, okay, time out, time out. We're not going to have biases here. The only bias we're going to have is what is my situation and how do I want to get to this goal line that I have designed, my goals, my freedom point. How do I get there? And what assets do I need? What's my plan need to be to execute to get there? That's all that there should be a bias about. Not, oh, I like cash value life insurance. Oh, you can't like cash value life insurance. No. Oh, I like real estate. Oh, you can't like real estate. No, they're all assets. Retirement accounts are assets, equities are assets, cryptos are assets, minerals and metals are assets, real estate's assets, cash value life insurance assets, savings accounts an asset. They're all assets, including the use of liability and leveraging those assets to create liability that leads to assets. Okay. The leverage is an asset. Time is an asset. All of these things could be liabilities if you don't structure and create a plan appropriately. Think about that. All of these can be a liability if you don't plan or structure these things correctly. So, but I have assets. but if not planned correctly. So, for example, I see this all the time with equity brokerage accounts. We work with a lot of high income earners, and they have a lot of times have a nice size, decent size brokerage account that they've accumulated over a period of time. A lot of them work with advisors. Um, and what you'll see is the advisor will have them diversified, but their traditional IRA, their Roth IRA, and their brokerage account are all allocated the same, but it's diversified, but each account's allocated the same. Okay. Well, those are different tools. If you think about it, a Roth IRA, yes, your dollars are imprisoned, right? You're not going to be able to have access. They're not going to be released till after 59 and a half. So they're serving their time between now your age and 59 and a half. But remember, Roth IRA dollars, at least right now in current laws, are tax free. There's no required minimum distribution because the government's not going to earn any taxes. So why do they require you to distribute something that's tax free? Okay. Now, the interesting thing about that is that why would I be conservative that? Why would I want that account to be conservative or balanced? Let me step in here really quickly and throw a quick little disclaimer here. We're not giving investment advice. We're not giving tax legal advice. We're giving you information and education. That's all this channel is for. So hopefully it's always treated as such. But I want to be very specific right now on this particular topic and the direction we're going is that this is educational, informational advice only. Okay. So when you look at these assets and you look at like the equities I was talking about, why would you treat a Roth IRA account the same as a brokerage account? Here's what's interesting too. I have members who come to us, they give us their account statements, and they'll have Nvidia, Google, Apple, Microsoft, Berkshire Hathaway as individual stock holdings. And then they'll have, and let's say that's going to be about 30% of their holdings. The other 70% is diversified. I use air quotes, diversified into S&P 500 and other types of EFTs and mutual funds. But they're diversified. No, 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 no. They were in a speedboat with the anchor. When you do that, you create duplication, not diversification. You create an overlap. Why in the world would you have somebody own individual stock holdings and then throw in an S&P 500 ETF in there? Makes zero sense. You're basically in a speedboat, you throw the anchor out and you're expecting the speedboat to go, but you're dragging this anchor. Makes no sense. So duplication is not diversification. That's very important in understanding the anatomy of a account and investment portfolio. Okay, huge. Now the finance industry they teach that, right? You use ETFs and mutual funds to diversify. You don't see a lot of individual stock holdings anymore. Now, what's interesting is that the accounts that I do see that are all individual stock holdings, there's not a duplication. Huh? Wonder why? Because they're in individual stock holdings. Now, there may be a concentration in a particular industry or not, and that's what creates that risk because of the industry concentration. Depends depends right? What the goal of you are, what's your goal, right? And sometimes your goal and your risk tolerance don't match up. I want this goal, but my risk tolerance is this. So we got to find out where's that medium, or which one is more important. Is your risk tolerance really more important, or is it less important? Is your goal more important or less important? We got to find this balance to be able to create this portfolio. But here's the thing, I'm just talking about equities, right? So, how do you utilize real estate? How do you use cash value life insurance? How do you use business alternative assets in this overall mixture of what you're trying to create? That's what the asset buddy system does. It looks at each asset and how to get these assets working and builds a plan to say, okay, these assets are going to work together, right? So I have a lot of clients that say, hey, Bob, should I do a 529 plan? Well, it depends. Depends. Do you know for sure, guaranteed, your kid's going to go to college and they're not going to get academic scholarships? Do you know, is that a guarantee? Then, if not, you're imprisoning your dollars with an assumption. At least with retirement funds, you know at some point you're going to retire, or at best case scenario, you're going to hit 59 and a half, right? I mean, at the end of the day. So you're imprisoning the dollars with retirement accounts, but you know you're going to have access to those dollars without penalty. 529 plan doesn't work that way, right? So what happens if your kid goes to college, but they get all academic scholarships and you have, $400,000 saved up in 529 plans that your kid's not going to ever use? Never mind. We don't need the scholarships. We saved money. We'll spend our own money. Hell no, you're not going to do that, right? You're going to take the scholarships. Then what? Then what? Right? So now, just recently, the government has come out with certain regulations and some adjustments to 529 rules for this particular situation, and that you are able to roll them over into Roth IRAs, but there's limitations. As you can imagine, when the government does something like this, there are limitations. But what if we took the Robert Kiyosaki Rich Dad Poor Dad approach and said, hey, what if I took this money that I was going to save into 529 plans? And what if I actually, instead of putting 529 plans into the equities market, because I already have my retirement money in the equities. So do I want to be fully concentrated into equities, or do I want to create this diversification, this balance? What if I take that money that I would normally put into a 529 plan for my kids' college, and what if I use that and put it into an asset? Just let's say we bought a fourplex, just as simple as that. A fourplex, we Airbnb all 4 units, or you have, one, two long termers, two Airbnbs, however you want to split this up, right? And that asset is designed to pay for kids' college. Okay. So as it's kicking off income, as it's building equity, you can utilize that asset to buy other assets, or even to use that cash flow to put into a cash value life insurance policy. Use that life insurance policy, cash value life insurance policy equity, as college funding if you need to. If they end up going to college, they don't get any scholarships, you should have access to that liquidity. It's yours. Or then all of a sudden they hit college, use the cash flow from the real estate property to pay for school. Once that expense is done, you still have the asset. That's the point what Robert Kiyosaki is talking about, is that you want to buy an asset to pay for the expense, because when the expense is paid for and you no longer have that expense, you still have the asset, right? And control a decision of, do I keep the asset after they graduate, or do I sell the asset now that it's served its purpose? Right? You see the idea. So the asset buddy system is really kind of looking at assets to be more productive. But when you make these decisions that we're talking about, it's all linked to the tax code. So there's different tax benefits and certain situations, and kind of this marionette of the puppets. Okay. We got to build out a plan that's very specific on how that works. Okay. So very important to understand the asset buddy system in your world, in your life. What's that mean? And if you've already done a great job of accumulating assets, and now you're sitting here going, ah, I got this tax liability, I've got all these assets, I've been doing everything myself, and now I don't know what else to do. Now you got to start figuring out a game plan for the next evolution. One of the things that people forget is that we do outgrow relationships. Think about friends you've had over the years, right? Sometimes you outgrow those relationships. Think about jobs, careers. You sometimes outgrow that position. The same is true with your money and your advisors and your wealth. Sometimes we outgrow those things. In fact, sometimes we outgrow ourselves, meaning, for example, I'll give you an example. When my son was younger, coached him in rec. And then as he got older and he got better in soccer, I realized, ooh, he needs somebody else. He's outgrown me. And so we put him on a separate team, a different coach, so he can grow in, because he outgrew me. The same could be true with you managing your own assets. Maybe you've grown your assets to this point and now you've outgrown yourself. Now you've built it, you've done a great job, But now you have to have the mindset of, okay, I need next level because I don't have the time to learn about next level, or I can just keep doing what I'm doing. And now what I'm doing, I'm dragging my return, right? Not only am I dragging my return, I'm dragging my tax benefits. I'm dragging my opportunities of hitting my freedom roadmap goals or my freedom goal, my freedom point. It's your money. You can do that. But have the mindset of, okay, what am I trying to accomplish? And understanding the asset buddy system is that this evolution of growth needs to continue to occur. The move forward needs to continue to occur. So this is that time of the year where we reflect on this. We're filing our taxes. We're looking at this kind of stuff. Look at the 1099s you're getting from your for your Schedule B from all your assets you're holding, whether it's real estate, whether it's savings accounts, brokerage accounts, whatever the case may be. Look at your income statements that you're getting for your tax preparation, and think about the taxes that you're paying on those dollars and how that's dragging your return down, and what's that gonna look like this year in 2026 moving forward, okay? It's a big deal. It's a tough thing to think about, but you deserve it because you worked really hard for those dollars, so you shouldn't just let them being thrown away out of pride or ego, but you should really focus on, if this is a business, if building our wealth, if building our retirement nest egg is a business mentality. I got to build this, so I have to have a business mentality. I got to treat it as such. Then we need to take some of the emotions of that out and look at it from a logical perspective. Hard to do, easy to say, hard to do. So hopefully this was helpful. Appreciate your time and investing your time with us. Go make it a great day.